Well, record highs, we've seen a number of them in the U.S., 22 to be exact for the S&P 500. And in fact, the S&P is on track for 5 straight months of gains for only the second time in 24 years. Is the outperformance built to last? Our next guest thinks we could see some downside potential as price targets suggest maybe we finish lower by about 5% by the end of the year. Let's bring in Paul Christopher, head of global market strategy at Wells Fargo Investment Institute. It's great to be with you, Paul. And I'd love to unpack kind of your target of 4,900 because most strategists have hit their targets already, right? Year-end targets 3 months into the year. And so they're faced with the decision, am I going to nudge it up or am I going to hold firm or do I see some downside? Why are you in kind of the downside camp for now?
Well, in the downside camp, I think, and I should say, Amber, that the perspective on that might change quite a lot if we see a pullback this spring. And we are entering a seasonally weak period. There's a whole lot of cash that's going to be collected by the IRS this month. And in general, it's just the liquidity is not quite what it was. So pullback, trees don't grow to the sky, markets don't go to the sky. A pullback from here would make it seem more reasonable, some of these lower targets. And ultimately, it has to do with the economy. So the economy is slowing. And if you look below the top line number that gets reported every month or every week, you'll see some weaknesses developing, whether it's in the labor market, whether it's in consumer spending, whether it's in credit, whether it's in liquidity. The economy is definitely slowing. We think there will be a pivot point to more sustainable growth later this year, but we have to come to that realization first. And I should say the markets need to come to that realization. And
so to the crux of your view is you're willing to be constructive on equities. It sounds like maybe valuations are really the key factor in what's holding you back.
Yes, that's right. This has been a rally for the last 5 months that's been all about valuations. Earnings, at $245 a share on the S&P, that looks a little bit rich to us, given that the economy is slowing. So yes, we need valuations to come back in before we can start to think about buying.
I wonder if style is going to matter in terms of, we talk often about this rotation, although it's still kind of these 4 stocks now. It's only 4 of them that are making up nearly half of the gains so far this year. So still quite concentrated. But if, we do get these rate cuts, even if we don't, if value has an opportunity of shining here.
Probably not in the near term anyway. The quality is done quite well if you look at factors. Momentum is knocking the cover off the ball, obviously, but quality has done quite well. And that's where our favorites are: industrials, materials, energy, and healthcare as well. And those first 3 have done pretty well in recent weeks. So we are seeing some broadening. That quality factor is something we want to keep in mind. So quality companies, those with good balance sheets, good revenue prospects, decent debt to cash flows, that's what we mean by quality. That one is doing well right now. Value, probably not for a while.
So that's interesting because and I'm just looking at the S&P Value Index versus the S&P Growth. In the month of March, you started to see value outperform meaningfully growth. And I saw a thesis today that if we don't get the same number of rate cuts that the market is pricing in, because the risk of rate cuts is maybe, that they get pulled back versus dialed up, that value stocks can outperform because, their multiples aren't as lofty and so they're not as reliant on low interest rates.
Yeah, it's a theory. I'm not sure how much water will end up holding because these companies that are generating the top 4, the top 7, they're generating quite a lot of revenue, and they're the ones that really have the strongest revenue prospects going forward. If rates rise, that's going to pull back those stocks. I'm not sure that it helps value enough with the economy slowing, even if you cut rates.
Materials is a really interesting sector right now. It was sort of left by the wayside for a long time. And now, as I mentioned, the materials sector in the U.S. is on a record hot streak. You've got gold prices, and it's so much more than that. But what gets you constructive about materials? What did you see in the sector before, many others were talking about it?
We've been long or overweight materials and industrials together since about the middle of last year, and really the driving force was recognizing that we have all of these fiscal programs here in the U.S. that are driving stronger spending on infrastructure, eventually spending on the electrical grid. Then we have reshoring by companies that are bringing their operations back from China, manufacturing, construction, and CapEx, or capital expenditures on machinery to fill those factories. That's going to be a driving force for the economy going forward. We still haven't really caught up on all those back orders from the pandemic. So we liked industrials and materials for those reasons back, oh goodness, almost a year ago when the valuations were lower.
And now they're at record highs. And you mentioned the valuation. Are you getting concerned, or do you think it still offers maybe we can call it relative attractive opportunities?
Yeah, these probably have a little while yet to run. What we're really looking at is that pivot point I mentioned earlier, where the economy finally stops slowing. Inflation has come down by enough because the economy has slowed, and then the Fed can cut interest rates. That's where we think the fuel comes from. With lower inflation, a slower economy, and then the rate cuts come, we think the economy pivots to faster, more sustainable growth, and that's where we really want to get interested in cyclicals. So you may see us do some horse trading at that point.
It's interesting because when we used to talk about materials, we were talking about a China growth story, right? And that being so much part of that, and that's not showing up kind of anywhere in your thesis. You're talking about reshoring, infrastructure spending. Is China a factor at all, or are you kind of screening out that factor?
China's still a factor. It still does a lot of building. It consumes a lot of materials, oil and copper in particular, iron ore, steel, and so forth. But the weakness in China right now is particularly in the housing sector and in the retail side. The Chinese household, the Chinese consumer seems reluctant to spend, reluctant to put down the down payment for those new homes, those new apartments. And so we think China's probably on the flat side in terms of demand growth, whereas the U.S. is on the upside.
I mean, it is kind of astounding, right, that you can talk about, a Caterpillar or the material sector at all-time highs, even with those headwinds in China.
Yes, yes, that's right. But the U.S. growth really is very strong right now. This is one where we think investors can still ride this wave, and we would be interested in staying favorable on all those sectors: industrials, materials, and energy. Let's not forget healthcare. That one hasn't quite participated like the others have, but again, long-term, really good growth prospects and attractive valuations here. So we keep that one in the mix with the favorites.
All right, Paul.